Everyone. I'm Marilyn Johnson with Great Way Real Estate, and I'm here today with Sean Beamer from Spire Financial. Sean, thank you for joining me today.
Absolutely. Thanks for having me.
So today we're going to talk about how to get started investing in real estate. And to do that, we, of course, will discuss the real estate market as it looks today. We'll talk to you about the benefits of investing. There may be some that you're not familiar with. And we're also going to discuss types of investments.
Obviously, Marilyn, there's lots of different types of properties that you can invest in. And we'll talk a little bit about all of these. Single families, townhomes, condos, vacation rentals are good for, the short-term stuff you probably hear a lot about. Multifamily, meaning, 2 to 4 units. And then all the way up to commercial real estate. We probably won't go too in depth into that, but obviously those are the basic types of properties people would invest in.
Great. And Sean, I understand you have a great program, a great plan for someone who has never invested in real estate before.
Absolutely. We call it house hacking. With interest rates being so great, lots of people, they probably want to move. But they've not really considered it seriously because they're sitting on a 2 or 3% interest rate, and it just seems cost prohibitive for you to move up to your new dream house. But if you've also at the same time ever thought about becoming a real estate investor, this is a great way to get started because you can, move into your new house, turn your current house with a 2 or 3% interest rate into a rental property. And most loan programs that I work with will allow you to actually utilize the rental income you get from that property to hopefully help you offset your new payment, which naturally will be higher, but eventually rates will come down and you'll have a chance to, refinance that property into a better payment. But the rental property that you just converted will always have that 2 or 3% interest rate. And in Denver, in a great market, rents increase about 8% a year, and even in a fairly flat market, they increase at 4% per year. So you're always going to be making great cash flow on that other property, and then down the line, you're going to have a great opportunity to refinance the new house you bought into a much better interest rate. It's the best way to acquire a portfolio. You just keep moving every couple of years. And then eventually you'll start building up cash flow to be able to not have to move and just buy rental properties and build yourself a nice little portfolio. The benefit to that is you could put a low down payment on a primary residence. If you buy a true investment property, it's a large down payment. But if you're buying your new primary residence, there's 5% down. There's 3% conventional down payment loans. Again, we can use the rental income from the departing property. You can pull a second mortgage off your current house to help with the down payment on the new one. And that's what we call leveraging, and we'll talk about that later. You can even buy 2 to 4 units on an FHA loan and utilize the rent from the other 2 to 3 units to offset your current mortgage payments. So it's just a great opportunity right now, whereas when rates do come down, competition will go up again. So right now is a pretty good time to negotiate a pretty good deal on a new home.
It does sound like a great plan, Sean. And in the market today, we've had a low inventory, low supply of homes available for sale for a long time. And it's one of the reasons why, even though interest rates have gone up, the housing market here just hasn't totally crashed like people expect it to, because there just isn't enough inventory to meet the demand for housing. There are always going to be people who need to buy and need to sell.
Absolutely. And I mean, this slide shows that inventory is historically low, which means property values are going to still rise, but there's times later in the market when, between fall and winter where it slows down a little bit. Those are good opportunities. But yes, the greater picture is that property values are going to continue to rise pretty much for the foreseeable future. They can't build fast enough.
Right. And this graph shows the real estate market in Colorado since 2010, which is when we were just starting to come out of the last economic crisis. And you can see in the top graph homes were staying on the market for 4 months on average before selling. And then as the economy improved, then that number dropped until 2015. I know we started having lots of bidding wars. So the average time on the market maybe was even around 40 days. And you can see the graph. I love this graph. It looks like a heartbeat because it shows that seasonal shift you were talking about. Everything slows down a little in the fall. Even in a strong market that we had, it would slow down a little in the fall and pick up in the spring and get crazy again. But look what happened right after the pandemic. First, we hit our lowest low where houses were selling sometimes for 10% over asking price. Going, I could list a house if it were average price or lower at that time. And I could tell my sellers with confidence, we will have an offer the first weekend. And we typically had between 5 and 10 offers the first weekend and that price point. But then it changed. Everything changed as interest rates started going up. And now we're back up to 40 to 50 days on market on average across the board. And buyers are now paying less than list price typically. If you look at the lower graph in 2021 and 2022, you can see where on average buyers were paying 6% over list price. That is not happening now except for in the lowest price ranges. So it is a good time to buy, especially if you have a workaround for current interest rates.
Well, Myrna, I like this slide because it kind of shows people that believe in the bubble that that bubble really doesn't exist, at least outside of anything that we see coming. There's always things that you don't see coming that could be coming, but this shows, housing starts basically versus completions and household growth and forecasted household growth. And you can see in 2002, again, a little bit after, the downturn in 97, 98, where we had household growth wasn't even competing with how many houses were being built, sold. And then you can see it slowly starts to overtake. It got really upside down here, but then you start getting into, 13, 14, it starts to equalize itself. And then now household growth just year after year outproduces what we can build. And then even into 22, this is a little older slide from, 21. But it forecast 22. It ended up being just like that. 23, we're definitely going to have a shortage of housing. And this graph goes out to the foreseeable future. And the last time we had the downturn, the reason we had the bubble is because of this. We had more housing than we had need for housing. So that always is going to cause property values to drop. And the opposite will be true when there is not enough housing for the demand.
Love supply and demand and economics 101. Okay, tell us about this slide, Sean.
This one just shows the growth that Colorado's, always a high growth market. So Colorado is a great place to invest. It shows all over the country. There's places hotter than Colorado, but we don't really need to spend a lot of time on that slide because it's just not as relevant as the appreciation that we're going to see because people want to come here, but we have high taxes, so people leave too. So that comes as well.
Right. And as we mentioned earlier, there are more benefits to real estate investing than most people realize. And the first benefit is appreciation, which we've been talking about. Housing prices rise. And so when you buy a home, anyone who owns a home currently or has for the past 2 years or more knows that the value goes up most of the time.
Absolutely. In fact, more times than not. If you're in real estate for the long game, it always goes up. You might get caught in a year or two where it's flat, or in 2007, 2008, it did downturn a little bit, but 4 years later, it was more than back anything they lost. So the long game is where it's at. It's real estate. Everybody knows about appreciation. Most people know about the capitalization rate. They call it cap rate. It's basically your rate of investment on your rental property. Your investment divided by your income, or by the income you pull in minus expenses. That's your cap rate. Leverage is one thing people don't really understand, and I like to explain why real estate is just a better investment. Leverage is when you use other people's money. And that's exactly what buying real estate is, especially when you use the house hack that we talked about, because you're going to put a very low down payment on that house. But when we're talking about leverage, we're talking about the rental property. So whatever you initially invested in that property, now it's worth $500,000. So if you were going to invest in equities or bonds or stocks or anything like that, you would need $500,000 to invest in $500,000 worth of stocks.
Mhm.
Well, with real estate, you can typically put a lot lower percentage down, so you're not using your own money, and get a gain off of that. And then you can use that as another vehicle to buy more properties. You can pull equity out of that property to buy another $500,000 property with a $20,000 investment, if you're doing the house hacking thing. So leverage is beautiful because you can get into the big game of investing with a very little amount of money. Now it is possible to be over leveraged, and you have to be careful of that. But all the big real estate investors, they understand leverage, and they understand that they get into a much bigger investment with a low capital rate from yourself. Another big thing is depreciation. Depreciation is another reason real estate investing is perfect, because every property has a set depreciation amount from the IRS. And they're going to give you credit for how much that house depreciates, because the land value always goes up, but the house gets older, so the house depreciates, the actual asset. So overall, you're going to have gain because the land's going up, but you get to write that off against your income. So if you made $10,000 on your rental income in a year, you would expect to pay $10,000 of taxes, right? Not 10,000, but whatever your tax rate is at that gain. Well, if depreciation is 9,000 on that property, you only have to show a $1,000 gain. So it's a great way to make income off your investments and pay very little, if any, taxes on it.
And here's an example of how homes can appreciate, excuse me. I just think it's wild that we get to use both of those words on the same investment. But if you'll notice, historically in Denver over the past 63 years, on average, real estate values have gone up by 4.75%. And Sean, that is across all years, even the years when maybe it wasn't going up as much, the average across all of those years. So in the past 10 years, it's been going up an average of 7.6%. And again, anybody that's owned a house during that time or owned a property has seen that increase.
Absolutely. And 4.75% when you're using leverage and you're talking about appreciation of 4.75 on $500,000 or $1 million investment, that starts to add up. If you're talking 4.75 on your CD that you put $1,000 in, that's going to take a lifetime to grow anything. So yeah, this just shows historically Colorado is a great place to invest in real estate. I don't think I've ever met anyone who bought real estate 5 or 10 years ago that's sad that they did. In the shorter term, we're seeing even bigger returns. Obviously, we've had quite a few years of run, but over 63 years, 4.75%. That does include even negative years that we've had. Mm-hmm. So once again, just proves, real estate is a fantastic investment if you're looking to grow wealth for your family.
And this map shows the average appreciation across the country since 1991 is over 300%. And in Colorado, it's even higher than that, 574%. I know my husband and I bought a house in 1992. We still own it today, and we bought it for $89,000. It's worth over $500,000 now. 6 times. It's increased, I would say 600% actually, because 574 is an average. But it's just wild. In 1992, I would have never thought that I would have owned a house that would be worth $500,000. But it keeps going up.
Absolutely. This just kind of goes over the cap rate we talked about. It's just your expected rate of return on your investment. It's a ratio. You can use it to compare properties, because buying a more expensive property doesn't necessarily mean a higher cap rate. So, doing due diligence on what types of properties, where to buy properties. Once you understand capitalization rate, you can even download tools to give you those numbers that if you just plug them in, and it just helps you find a better investment that might not be as expensive as some of the ones you're looking at. It factors all your costs, your taxes, your insurance, and then it compares it with the rent you're getting, and then that's going to generate a rate of return or cap rate. This just gives an example of, obviously, if you buy an expensive town or condo in town, Denver doesn't necessarily mean it's gonna have a better cap rate than something in the suburbs. Leverage, my favorite one. Like I said before, leverage is misunderstood. Not all debt is bad. It is possible to over leverage yourself. There were people in the late 90s or the late 2000s that ran into a little bit of trouble with that stuff because they just bought too many too fast at the top of the market. So, when you're doing the house hack stuff we talked about, you kind of insulate yourself from being over leveraged.
I'm sorry if I can just interject. What I hear the most is when we talk about cash buyers, people assume all cash buyers are investors, and people assume all investors are cash buyers. And that's not true.
In fact, smart investors don't pay cash because they have better things to do with their money. They can leverage these properties higher and get a rate of return somewhere else with that money. Once you become seasoned investor, you'll realize leverage is your best friend because right now interest rates aren't fantastic, but when rates were 2 or 3, you could do better than that anywhere. So there's just different times where paying cash just isn't quite as smart as using leverage. Now, everyone has their own thought process. I don't think there's an absolutely wrong way to do it by not leveraging or paying cash. Some people don't want the payments and they want to have that, peace of mind knowing that they don't know anything on the property. Myself, I'm a leverage guy. I believe in leverage, but doing it smartly. Now, depreciation, that is just what helps you offset your gains. There's going to be some depreciation on every property, and as far as I know, the IRS makes you take a depreciation. Now, they will recapture that depreciation when you finally sell the property. But for all those years that it was making money and in service to you, it's going to help reduce your taxes. I own 3 rental properties, and I basically show no gain on any of them just because of the depreciation. Now, at some point, I'll have to, come to terms with paying that back. But for all these years, I'm making the money and not paying any tax on it. Short-term rentals. I'm sure Marilyn's got.
Yeah. No, I was just going to say, one type of investment, I know several people who are doing this, is it's different from house hacking, but they basically go to their favorite vacation spot. And if they like vacationing there, then they buy a vacation home and then they rent it out to everyone else. So maybe they use it 1 or 2 weeks out of the year, or maybe 4 or 5 times. And the rest of the time they're making money on it. It's a great way to go.
That is a great way to get a vacation or second home, because then it can largely pay for itself, or even make a tremendous amount of money depending on how you do it. But like Marilyn said, you buy a house in Florida or Hawaii or wherever you want to buy a second home. And then you just schedule yourself out for a couple of weeks a year, and then you rent it on short-term basis through Vrbo, Airbnb, some of these other short-term rentals. They're a little more burdensome. There's a lot more work. They typically have to be cleaned, every time a new guest is going to check in, but the rate of return you can get is a lot more too. So it's kind of a risk reward thing. It's a greater risk, but potentially bigger reward as well.
And for house hacking, long-term rentals are probably better, wouldn't you say, Sean?
I would say that that's the majority of what people do, because typically they buy them locally where they can go visit them to make sure the property is being upkept, or have a property manager do that stuff. It's the more reliable, safe way to invest. And I'll admit that's all of my rentals are long-term rentals. I like knowing that there's someone in there that cares about the property. They pay on time every month. But yeah, short-term rentals, I probably could get more money, but I would be over there more often, or paying someone to be over there more often. So that's kind of my cup of tea, is a long-term rental, and that's probably your most standard way to do it. But again, if you have I've even heard of a house in, I want to say Milliken, that someone's making a ton of money. And I didn't think that was really a vacation type of place, but for some reason there's a demand for short-term rentals. So you just never really know.
I'll tell you, people go everywhere to visit relatives, right? And they don't always stay with them. I stayed with my parents in a short-term rental in my hometown where I grew up in Sallisaw, Oklahoma. There's like 5,000 people there, but somebody bought a house there and Airbnb'd it, and we stayed there. So
Mhm.
you never know. It pays to research the area, research the other places to stay.
And you definitely want to watch out for the municipalities. Every municipality has a little different rule. A lot of places are moving to the model where you can't do it on a short-term rental unless it's your primary residence. Now in Colorado, up in the mountains, they're never going to do that. But you know, your Winter Parks, your Breckenridges, your Vales, those are going to have short-term rentals and they're going to allow you to do it. But I believe Denver, Boulder, Bloomfield, a lot of these places won't let you do a VRBO. So just food for thought, before you get into a VRBO or a short-term rental situation, make sure where you're buying that's allowed.
Yes, definitely. And one of the things you'll need to consider are who your insurance carrier is. You want to talk to an insurance carrier to know your cost of insurance before you get into it. And also think about taxes. Not a bad idea to run everything past your CPA and see if they have any suggestions, recommendations for how to maximize your tax savings.
Absolutely. And just make sure you have enough coverage that covers you liability. Umbrellas are usually recommended for that type of stuff. So this just goes over kind of a recap of what we've already talked about. Tax advantages, the depreciation is a huge advantage, but it is recaptured at sale. Appreciations are realized at sales as well. Another thing that people use is 1031 exchange. That's basically just a tax code that allows you to defer the taxes. So every time you buy a new rental property, you umbrella into a 1031 exchange, which makes it not taxable when you sell it. The real purpose for that is if you have children. And let's say you have 5 children and you end up with 5 rentals, and you want to give each one of those children a rental. Well, normally, if you just gave it to them while you're still living, they would have to pay tax on all that gain. If you bought it at 200 and now it's worth 500, they have a $300,000 gain. With the 1031 exchange, along your passing, they take over that property. Well, they get to say that they purchased it for what it was worth when you passed away. So if it was worth 500, now they start at 500. And then if it gets to $1 million, they have a gain, but they start off at the new cost basis of the value when you left it to them. So it's a great tool to help your children, you know, leave them some money without a huge tax burden as well. You know, be happy to explain that more to anyone who's interested in 1031 exchange.
And Sean, I understand, as you mentioned before, you have purchased rentals in the past, and you've also helped other clients with house hacking.
Mm-hmm. Yeah, in fact, I have a case study coming up that we'll go over that kind of shows a recent deal we did where we did the house hacking.
Mm-hmm.
And this just goes over just your basic financing terms. You know, most people just do conventional 15% down to 25. I will say in this market, you really want to be 25 to 30 to have a reasonable interest rate. And this is if you're buying a straight rental. This is not the house hacking thing where you're buying a primary residence for yourself. There are debt service loans that really don't take your personal income into account. They just will lend you the money if you can prove that the house will cash flow. We order like an appraisal supplement to that, and we do comparables on the rent. And as long as it's about 75% of the mortgage, they'll lend you the money and they don't take your personal income into consideration at all. Then you have the hard money. That's just the fix and flip stuff. It's very short-term financing, very, very expensive, but it's short-term. So that's if you want to buy a house, fix it up and turn around and sell it right away. I don't help with that because I typically do, you know, your regular residential loans, and that's not, but happy to consult anyone on trying to do that. You know, the debt service loan, a lot of those will allow you to cross collateralize. So if you're really interested in buying a bunch, you can actually put one loan under all of your properties. A little more complicated situation for the seasoned investor, but you know, just give them education here. Again, commercial options. I don't typically do commercial loans, but anything over 5 units is commercial. So when you hear about people buying an apartment building, it's typically with a commercial loan. And then a bummer if you're doing a straight investment property, no gift funds are allowed. But if you're doing a house hack at your primary residence, you can get all the gift you want. And then here's what Marilyn was talking about, the case study. I recently ran into a homeowner that I did his previous loan many, many years ago, and he's got a landscaping business and he wanted more space. He wanted more, he had a barn, but he needed a bigger barn and more land to store his equipment and just everything he needs for his landscaping business. So he found the perfect property and we went back and forth. He could have probably netted $400,000 from the sale of his house to put down on the new one, but he ultimately decided to rent his current house or house hack, as we talked earlier, and then buy the new dream house. So he kept his other house as a rental, and he's cash flowing about $1,700 above his mortgage payment on that. So yes, his mortgage payment was higher than he liked on the purchase, but with the $1,700 coming on the other side, it made it to where it was bearable. And then he knows at some point in the future, he's going to be able to lower that payment, but he'll always have that 2.75% rate on the house he turned into a rental. So just wanted to give kind of an example of how that works.
Thank you. Thank you for that example. And thanks for joining me today, Sean. House hacking is, it's a great way to go if you've never invested in real estate before. And if you have any questions, you can call me, you can call Sean. Our contact information is here on the screen. And thank you for joining us today.
Absolutely. Thanks for having me, Marilyn. Appreciate it.